In this video we are going to talk about dividend stocks for retirement. So before starting, please like this video and subscribe to this channel for our future updates. In the absence of a regular paycheck, retirees must find alternate sources of income to ensure they do not outlive their income. Dividend-paying stocks are the best retirement stocks to buy in 2022. Regular dividends can reduce or eliminate the need to sell shares to generate income. The Omicron variant or rising interest rates are not concerns when owning a quality business portfolio. Number 10. Old Republic International. Old Republic International, ORI, $24.65, has paid dividends continuously since 1942, one of the best records in the cyclical insurance industry. Moreover, the corporation has raised its dividend for 40 years. General insurance policies connected to workers' compensation, trucking, and home warranty offers provide around half of commercial line underwriters' revenues. The rest of Old Republic's business is title insurance for homebuyers. It's all about risk management, and the Old Republic has excelled at it since its inception more than a century ago. In fact, in 41 of the last 50 years, the firm's general insurance segment has had combined ratios below the industry average. This ensures ORI's future. To reduce underwriting volatility and increase diversification, this business collects the full premium upfront. Despite the industry's cyclical nature, Old Republic remains one of the finest retirement stocks in 2022 due to its prudent financial procedures and meticulous underwriting. We expect ORI to continue paying special dividends. It does so every year as profits allow. If Old Republic pays a $1.50 per share special dividend in 2022, the stock's yield would be closer to 9.7%. Number 9. Regency Centers. It owns approximately 400 grocery-anchored shopping complexes, leased to over 8,000 tenants. With its investment-grade balance sheet and conservative payout ratio strategy, Regency was one of the few companies in its industry to maintain its dividend during the epidemic. As of late October 2020, Regency's open-air shopping complexes had already surpassed 2019 foot traffic figures. Regency's properties are resilient since they are close to clients and benefit from pandemic-driven suburban growth. These features should improve Rega's rental income and dividend. Number 8. American Electric Power. American Electric Power, AEP, $89.99, is one of the nation's largest electric utilities, serving 5.5 million customers in 11 states, including Ohio and Texas. AEP's vertically integrated utilities and transmission and distribution utilities generate nearly all of the earnings. These regulated businesses have steady revenue streams and room to grow. American Electric Power's aging transmission and distribution lines, as well as opportunities to connect remote wind and solar farms to the grid, are expected to drive 5 to 7% annual earnings per share growth. With a conservative payout ratio objective of 60% to 70% and an investment-grade credit rating, AEP is one of the finest retirement stocks for 2022 and beyond. Number 7. Merck. Merck, MRK, $80.50, has paid annual dividends since 1971, demonstrating the company's robust research methodology, huge distribution network, and financial conservatism. The broad range of high-margin pharmaceuticals, and the June 2021 divestiture of Merck's Organon, OGN, business boosted Merck's mix of drugs with good patent protection, according to Morningstar Equities analyst Damian Conover. Conover anticipates major new medications from Merck's drug research strategy. This pipeline should help control patent expiration dates and keep the business strong and dividend-paying. Number 6. Brookfield Infrastructure Partners LP. Brookfield Infrastructure Partners LP, BIP, $60.40, is a master limited partnership that owns Global Infrastructure Assets, MLP. Brookfield owns railroads, ports, pipelines, telecom towers, power transmission lines, and data centers, unlike other energy companies. But like regulated utilities, the firm's assets are hard to duplicate and generate annuity-like cash flows. Brookfield's adjusted EBITDA is backed by regulated or long-term contracts to the tune of 90%. This stability has helped Brookfield increase distributions every year since 2008, along with an investment-grade credit rating and a global infrastructure investment strategy. Investors can expect more of the same, with management predicting 5 to 9% annual distribution growth. Unrelated business income is not generated by the partnership. Unlike most limited partnerships, Brookfield's units can be held in non-taxable accounts. For investors who prefer corporations to partnerships that issue K-1 forms, Brookfield Infrastructure Corporation trades, BIPC. In a traditional corporate structure, BIPC shares equal BIP units. They are distributed like BIP units. Number 5. Kimberly-Clark. From Huggies to Kleenex, Cottonelle to Scott, Kimberly-Clark, KMB, $141.61, has built a leading array of tissue and hygiene goods. A quarter of the world's population uses a Kimberly-Clark product daily. This large, recurring demand allows the company to spend more on marketing, gain economies of scale, and reach more retailers than smaller competitors. Kimberly-Clark has traditionally generated predictable returns in many different settings, making it one of the finest retirement stocks on the market today. Dividend aristocrats have increased dividends for 49 years running, putting them on course to become dividend kings in 2022. Due to global population growth, KMB will never be the fastest growing company, but it can protect a conservative retirement portfolio. Number 4. Dominion Energy. Dominion Energy, D, $79.09, a large diversified utility, surprised investors by selling its natural gas transmission and storage business in July 2020. This segment contributed significantly to the company's earnings, necessitating a 33% dividend cut to better align with Dominion's ongoing cash flow. As a result of this asset transaction, Dominion's growth profile improved. Instead of the previous long-term target of 5%, management now anticipates 6.5% annual earnings growth between 2022 and 2025. Dominion's dividend is also scheduled to rise 6% yearly, quicker than the previous objective of 2.5%, though this is now off a smaller base. Regardless, Dominion raised rates by 6% in December 2021 and investors should expect more in late 2022. Investors should also note Dominion's industry-leading energy profile, which reflects its utilities investments in wind, solar, and battery storage. Regulators and investors alike are expected to favor these attributes in the coming years. Given the recent dividend drop, Dominion will be viewed with suspicion. Overall, simply safe. Dividends feels D shares provide long-term investors a good mix of income and growth. Number 3. Lockheed Martin. Lockheed Martin, LMT, $369.40, is the world's largest defense contractor and supplier of fighter aircraft. Lockheed's products include missile defense systems, military helicopters, satellite systems, and numerous combat aircraft. Lockheed has had a long-standing partnership with the government because of the complexities and sensitivity of creating weapons systems for national security. With a substantial backlog of contracts and careful financial measures, Lockheed has paid dividends continuously since 1995, increasing them every year since 2003. However, despite recent stock market volatility and concerns over the defense budget, Simply Safe Dividends anticipates Lockheed's dividend to remain safe. Lockheed is also trading at a discount, according to CFRA analyst Colin Scarilla, motivated by market anxiety about defense funding cuts under Democrats. On the other hand, Lockheed's earnings per share increased 10% yearly during 2012 to 2015, despite a 4% decline in defense spending. Lockheed is one of the greatest retirement stocks to consider, as it is expected to continue generating higher dividends in the years ahead. Number 2. General Mills. General Mills, GIS, $68.42, and its predecessors have been in the restaurant, garment, and toy business since the 1800s. In 1995, the company moved its concentration to consumer packaged meals. With the company's evolution, its dividend has stayed constant, making it one of the best retirement stocks today. Since 1898, GIS has paid annual dividends. General Mills' current portfolio encompasses major non-perishable food categories. Included are well-known products like Cheerios' cereal and Blue Buffalo. Pet food. General Mills' popular brands and broad distribution network have helped it create consistent cash flow in all economic times. Consistent consumption of meals has also helped. According to Simply Safe Dividends, a strong portfolio of brands, strong distribution connections, and a high credit rating should keep General Mills and its dividends safe for many years to come. Number 1. Flowers Foods. Bread has been a household staple for years, and Flowers Foods, FLO, $27.86, has been providing it since its founding in 1919. Breads, buns, snack cakes, and rolls are sold under a variety of popular brands, including Tasty Cake, Nature's Own, Dave's Killer Bread, and Canyon Bakehouse. Most of the categories in which Flowers competes are mature and have predictable demand trends, as is the case with many consumer staple stocks. Flowers has managed to increase its dividend every year since its inception in 2002, owing to strong cash flow creation in a variety of economic circumstances. Flowers should remain one of the top retirement stocks for 2022, with an investment grade credit rating, a moderate payout ratio near 70%, and the number 1 brand in the faster-growing organic and gluten-free bread categories. What do you think about our video? Please let us know in the comments area below. If you enjoyed this video and would want to hear from me again, please subscribe and turn on the notification before leaving. Thank you for watching us.